The fundamental difference between those who build wealth and those who remain in the same financial situation for decades is not in the amount of money they earn, but in how they think about it. Robert Kiyosaki identified that there are two completely opposite mentalities when it comes to money. The poverty mentality operates with the belief that money is scarce, difficult to get, and must be saved at any cost. People with this mentality work for money, trading time for salary, always dependent on a job or single source of income. They think in terms of immediate security, like, I need a stable job. It's better not to risk. I'll save in savings because it's safe. The wealth mentality, on the other hand, sees money as an infinite tool that can be multiplied. These people make money work for them, creating systems that generate income even when they sleep. They think in terms of opportunities like, how can I make this yield more? What problem can I solve and be paid for it? How can I create value for other people? The first step to developing a wealth mentality is to replace limiting statements with expansive questions. Instead of saying, I can't afford this, ask, how can I afford this? Instead of, I don't have money to invest, ask, how can I create money to invest? Your brain is a problem-solving machine, but it needs to receive the right problem. The wealth mentality also involves accepting that money is neutral. It's neither good nor bad. It's a tool. And like any tool, the better you know how to use it, the better results you'll get. Rich people aren't ashamed to talk about money, don't think it's ugly to want more money, don't feel guilty about prospering financially. Robert Kiyosaki always emphasizes that in school we learn to work for money, but we never learn to make money work for us. This educational gap is responsible for keeping millions of people trapped in the cycle of earning, spending, and starting over. Financial education is not a luxury or hobby, it's the most important asset you can develop. Unlike other investments that can depreciate, financial knowledge only multiplies over time. When you understand how money works, every reel that passes through your hands has the potential to transform into much more. The first level of financial education is understanding basic concepts like inflation, compound interest, diversification, risk, and return. But the second, more advanced level is developing financial intelligence, which is the ability to solve financial problems, identify opportunities, and make decisions that multiply your wealth. The financially educated person knows that 1,000 reais today won't have the same purchasing power 10 years from now because of inflation. That's why they don't leave money sitting idle. They understand that investing 500 reais monthly at 1% per month for 20 years results in more than 400,000 reais, while saving the same amount without return results in only 120,000 reais. More importantly, financial education teaches that there are different types of income. Linear income depends on your direct work. Stop working, stop receiving. Passive income continues coming even when you're not actively working. Residual income multiplies over time through systems you create once, and that continue generating results. Investing in financial education means reading specialized books, taking courses with recognized professionals, participating in investment groups, following the financial market, and especially applying knowledge in practice with discipline and consistency. This is possibly the most transformative lesson that Kiyosaki teaches, and also the most misunderstood. The definition is simple. An asset puts money in your pocket, a liability takes money out of your pocket. But in practice, most people buy liabilities thinking they are assets. The most controversial example is home ownership. Our culture teaches that buying a house is the best investment someone can make. Kiyosaki challenges this belief. If your house doesn't generate monthly income for you, it's a liability. Every month you pay financing, property tax, condo fees, maintenance, insurance. The house only becomes an asset when you transform it into a source of income by renting it, for example. True assets include real estate that you rent for more than you spend to maintain them, stocks that pay regular dividends, public and private bonds that pay interest, businesses that function without your daily presence, real estate funds that distribute monthly income, intellectual property royalties, investments that appreciate over time. Liabilities commonly confused with assets include cars that depreciate rapidly and generate monthly expenses, financed homes that generate expenses without generating income, investment objects like expensive watches or artwork, unless they are rented or consistently appreciate, loans and financing, poorly used credit cards. The millionaire's strategy is devastatingly simple. They use work income to buy assets and use asset income to buy more assets. Over time, asset income surpasses work income, and they achieve financial independence. The great insight is understanding that the rich buy assets first, luxuries later. Poor people buy luxuries first and never have money left for assets. If you want that new car, first buy enough assets so that their income pays for the car. This way, you have the car and still maintain or even increase your wealth. Many people believe they'll become rich when they receive a big salary raise or substantial inheritance. Kiyosaki reveals an inconvenient truth. It doesn't matter how much money you earn, but how much money you can keep and make work for you. Cash flow is the difference between what comes in and what goes out of your pocket every month. But there's a crucial distinction between active cash flow that depends on your work and passive cash flow that's independent of your physical presence. Successful professionals often have high active cash flow, like doctors, lawyers, executives who earn $20,000, $30,000 or more per month. But if they stop working, income stops immediately. They're like hamsters running on a wheel. The faster they run, the faster the wheel spins, but they remain in the same place. Passive cash flow, on the other hand, is the holy grail of wealth building. It's income that arrives in your account even when you're sleeping, traveling, or recovering from illness. Examples include property rentals, stock dividends, bond yields, profits from businesses that function without your presence, royalties and licensing, income from investment funds. The goal isn't to have gigantic passive cash flow immediately, but to build it consistently until it surpasses your monthly expenses. When this happens, you achieve financial freedom. You can choose to work for passion, not necessity. Building passive cash flow requires patience and discipline. It starts small, maybe 100 or 200 Rs monthly in income. But these amounts are reinvested, creating a snowball effect. Over time, growth accelerates dramatically due to the power of compound interest. One of the biggest mistakes people make when trying to build wealth is waiting to have a large amount to start investing. Kiyosaki teaches that great fortunes aren't born from large initial investments, but from small, consistent investments that accumulate over time. The principle behind this strategy is that you learn by doing, not by studying theory indefinitely. When you start small, mistakes are also small and cheap. Each mistake becomes a valuable lesson that prepares you for larger investments in the future. Starting small also removes the psychological barrier of analysis paralysis. Many people spend years studying the perfect investment while they could be learning in practice and building wealth gradually. The perfect investment doesn't exist. What exists is the investment you can make today with the knowledge and resources you have today. The small start strategy works because it harnesses three powerful forces. First, habit. When you invest small amounts regularly, you develop the muscle of financial discipline. Second, practical knowledge. Each investment teaches something new about the market. Third, psychological momentum. Small wins generate confidence for larger investments. Many of the world's greatest investors started with trivial amounts. Warren Buffett bought his first stock at 11 years old with $38 he had saved. Luiz Barsi started investing in the Brazilian stock market with 100 reais in the 70s. The important thing wasn't the initial value, but the consistency and patience to let time and compound interest work in their favor. The mentality of starting small and thinking big also applies to businesses. Many billion-dollar companies started in garages or student dorms. Amazon, Google, Apple, all started with limited resources but expansive vision. The secret is to start with what you have, where you are, and constantly improve. One of Kiyosaki's most advanced and controversial lessons is about the strategic use of debt. While conventional wisdom says all debt is bad, Kiyosaki distinguishes between good debt and bad debt. The fundamental difference is that good debt puts money in your pocket, while bad debt takes money out of your pocket. But debt includes car financing, credit cards for consumption, loans for vacations, or other expenses that don't generate financial return. These debts erode your wealth and limit your ability to build wealth. Good debt, on the other hand, is used to acquire assets that generate more income than the cost of the debt. For example, if you get financing at 10% per year to buy a property that yields 15% per year, you're using positive leverage. The 5% difference is pure profit that increases with the size of the investment. The concept of leverage allows you to buy larger and better assets than would be possible with just your money. If you have 50,000 reais and can finance 200,000 reais for a 250,000 reais property, you're controlling an asset 5 times larger than your initial capital. But leverage is a double-edged sword. Just as it amplifies gains, it also amplifies losses. That's why it's crucial to completely understand the investment, make conservative analyses, and always have a margin of safety. The golden rule is never to leverage beyond your payment capacity, even if the asset's income stops temporarily. Rich people use leverage strategically, while poor people are used by leverage. Rich people take loans to buy assets that pay for the loan and still generate profit. Poor people take loans to buy liabilities that increase their monthly expenses. Intelligent use of leverage requires solid financial education, practical experience, and emotional discipline. It's not a strategy for beginners, but for investors who already master basic concepts and have a history of prudent financial decisions. Kiyosaki always emphasizes that waiting for the perfect moment to invest is one of the biggest traps that keeps people financially stagnant. The perfect moment never comes because there are always uncertainties in the market, always reasons to delay, always a convenient excuse. The year 2026 represents a unique opportunity for several reasons. First, we're coming out of a period of high global economic volatility that created price distortions in various assets. Second, interest rates are in a normalization process, creating opportunities in both fixed and variable income. Third, technology is democratizing access to investments that were once exclusive to the very rich. But the most important reason to invest in 2026 is pure mathematics. If you have plans to become a millionaire by 2030, for example, each year of delay drastically reduces your chances of success. Compound interest needs time to work, and lost time never fully recovers. Consider 2 scenarios. Ena starts investing 1,000 reais per month in 2026 with an average return of 12% per year. In 2030, she'll have approximately 60,000 reais. Bruno waits until 2028 to start with the same monthly 1,000 reais and same profitability. In 2030, he'll have only about 25,000 reais. Ana took advantage of 2 extra years of compound interest and ended up with more than double. The Brazilian market in 2026 offers specific opportunities. The stock market is still relatively discounted compared to developed markets. The real estate market is recovering from price adjustments. New investment modalities like real estate funds and startup investments are becoming popular. Additionally, 2026 marks a maturity moment for Brazilian fintechs that have drastically reduced investment costs. Today, you can start investing with 10 reais, have access to professional reports, diversify in hundreds of assets, and all of this through your phone. The mentality of waiting for the perfect moment is a symptom of the poverty mentality. Rich people know that the best time to invest was yesterday. The second best time is today. They understand that time in the market beats market timing. One of the most striking characteristics of millionaires is that they rarely depend on a single source of income. While most people have only their salary as money input, the rich diversify their income sources as a way to reduce risks and accelerate wealth building. Kiyosaki identified that there are basically 4 types of income you can build. Work income, which is your salary or payment for services rendered. Business income, which is profits from companies you own. Investment income, which is dividends, interest, rent, and capital gains. Passive income, which is royalties, licensing, and other forms of income that continue coming without active work. The intelligent strategy is to start with work income, use part of it to build investment income, and gradually develop business income and passive income. Over time, the goal is for passive income to surpass your monthly expenses, guaranteeing financial independence. Let's see practical examples of multiple income sources. Maria works as a marketing consultant, earning 8,000 reais monthly. She uses 2,000 reais to invest in dividend-paying stocks, generating 400 reais monthly. With accumulated knowledge, she created an online marketing course that generates 1,200 reais monthly in royalties. She also bought a commercial room that she rents for 1,800 reais monthly. Total income sources: 4. Total monthly approximately 12,000 reais with 4,000 passive. The concept of multiple income sources also offers security. If Maria loses her main job, she still has 3,400 reais monthly from other sources while looking for new placement. This security reduces financial stress and allows for more strategic, not desperate, career decisions. Building multiple income sources requires planning and discipline. You can't simply wish to have more income. You need to create systems that generate income. This means developing marketable skills, consistently investing in assets, creating products or services that meet market needs. The digital era has greatly facilitated the creation of multiple income sources. You can create online courses, sell digital products, be an affiliate for other products, invest in real estate crowdfunding, buy fractional stocks, all of this with relatively low initial investments. Kiyosaki always emphasizes that you are the average of the 5 people you spend the most time with. If these people have a scarcity mentality, constantly complain about money, and believe that rich people are dishonest, it's very likely you'll develop the same limiting beliefs. On the other hand, if you live with people who naturally talk about investments, who share business opportunities, who celebrate financial successes, you absorb this abundance mentality almost by osmosis. The social environment is one of the most underestimated factors in wealth building. But how do you expand your social circle if you don't yet have connections in the investment and business world? Start by attending events related to finance and entrepreneurship. Participate in investor groups on social networks. Take courses where other participants are also interested in financial growth. Be genuinely interested in helping other people, and naturally they'll reciprocate with information and opportunities. Mentorship is another crucial component of financial success. A mentor doesn't need to be a famous billionaire. It can be someone who has already achieved the financial level you desire and is willing to share knowledge. Mentors accelerate your learning because they've already made mistakes you can avoid and identified strategies that work. There are several forms of mentorship. Direct mentorship, where you have personal access to the mentor through conversations or meetings. Mentorship through content, where you intensively study books, courses, and lectures by successful people. Group mentorship, where you participate in masterminds or study groups with people at similar or higher levels. The most important thing about mentorship is being a good student. This means implementing received advice, asking intelligent questions, being respectful of the mentor's time, and eventually helping other people who are starting out. Mentorship is a two-way street based on mutual value, not just unilateral requests for help. Your social circle also includes the professionals you hire: accountant, lawyer, financial consultant, real estate broker. These professionals can be partners in building your wealth, or they can be just basic service providers. The difference lies in the quality and strategic vision they bring. Kiyosaki often says that building wealth isn't about doing something extraordinary once, but about doing ordinary things consistently for a long time. Financial discipline is like physical exercise. Results come from daily repetition, not sporadic intense efforts. Financial discipline starts with expense control, but goes far beyond that. It includes discipline to continuously study investments, discipline to reinvest profits instead of spending them, discipline to maintain long-term investments even during market volatilities, discipline to say no to opportunities that seem good but don't align with your strategy. Consistency is equally important. Investing 1,000 reais per month for 10 years is infinitely more effective than investing 10,000 reais once per year for 10 years. Compound interest works better with regular contributions because it takes advantage of both market highs and lows through the concept of average price. One of the biggest battles of financial discipline is against emotional impulses. The market goes up and you want to invest everything at once for fear of missing opportunity. The market falls and you want to sell everything for fear of losing more money. Discipline is maintaining strategy even when emotions are screaming to do differently. Small daily habits shape large wealth over time. Writing down all daily expenses, reading 15 minutes about investments before sleeping, automatically separating 20% of income for investments before any expense, monthly reviewing portfolio performance without making hasty changes. These habits seem insignificant but compounded over years create extraordinary differences. Discipline also involves having systems that work automatically. Automatic debit for investments, automatic transfer to specific emergency account, automatic reinvestment of dividends. The more you automate correct decisions, the less dependent you become on daily motivation, which is volatile and unreliable. Consistency doesn't mean total rigidity. It means having a clear direction and adjusting tactics as needed while keeping the general strategy intact. It's like navigating a boat. You maintain the destination but adjust the sails as the wind changes. One of the great differences between people who build wealth and people who remain financially stagnant is their attitude toward risk. Kiyosaki teaches that not taking risks is the biggest risk of all because it guarantees you'll never achieve financial independence. But there's a crucial difference between taking calculated risks and gambling irresponsibly. Calculated risk means completely understanding the investment, knowing possible scenarios, having strategies for different situations, and never betting more than you can lose without compromising your basic security. People with a poverty mentality see risks as threats that must be avoided at any cost. They prefer the false security of leaving money in savings, losing purchasing power to inflation, rather than risking investing and potentially earning much more. This overly conservative mentality is paradoxically risky because it guarantees gradual impoverishment. People with a wealth mentality see risks as opportunities that must be intelligently managed. They know that every investment has risks, but also know that education and diversification can reduce risks while maintaining high return potential. They prefer the known risk of market volatility to the certain risk of inflation eroding their money. Learning to evaluate risks is a skill that develops with education and experience. It starts with understanding basic concepts like risk-return relationship, diversification, correlation between assets, and investment horizon. It evolves to more sophisticated analyses like discounted cash flow, market multiples, and technical indicators. Risk management also involves correct position sizing. Even the world's best investment can break you if you bet too high a percentage of your wealth on it. The general rule is never to concentrate more than 10% of wealth in a single specific investment. Diversification is the most important tool for managing risks. This means spreading investments across different asset classes, different economy sectors, different geographic regions, different maturity terms. When one investment goes bad, others may be doing well, compensating for losses. The concept of risk also changes as your wealth grows. When you have little money, you can take bigger risks because you have time and ability to recover losses through work. When you have significant wealth, you need to be more conservative to protect what you've already achieved. Kiyosaki's last secret to becoming a millionaire in 2026 is having a specific, detailed, and measurable plan. Dreams are important for motivation, but plans are essential for execution. The difference between wanting to be a millionaire and becoming a millionaire lies in the specificity of planning. A clear objective has 5 characteristics. It must be specific, measurable, attainable, relevant, and have a determined deadline. Instead of saying, "I want to be rich," say, "I want to have 1 million raise in net worth by December 2026. Instead of saying, "I want to invest better," say, "I want to invest 2,000 reais per month in a diversified portfolio with 60% stocks and 40% fixed income." Financial planning starts with diagnosing the current situation. How much wealth do you have today? How much do you earn monthly? How much do you spend? What are your debts? What's your savings capacity? Without knowing the starting point, it's impossible to chart an efficient route to the desired destination. The next step is defining intermediate milestones. If the goal is 1 million in 2026, what should the values be in 2024 and 2025? If the target is 2,000 reais monthly in passive income, how does this divide among different income sources? Intermediate milestones allow route adjustments before deviations become irreversible. The plan should include specific strategies for different scenarios. What to do if income decreases temporarily? How to react if the market enters a bear market? What opportunities to take advantage of if extra money appears? Scenario planning reduces emotional decisions during crises and opportunities. Progress measurement is fundamental for maintaining discipline and motivation. Monthly reviewing net worth comparing with established goals. Quarterly analyzing investment portfolio performance. Annual evaluating whether strategies are working and what adjustments are necessary. The plan should also be flexible enough to evolve as you learn more about investments and as your personal situation changes. Excessive rigidity can make you miss better opportunities that arise along the way. Excessive flexibility can make you lose focus and consistency. Finally, the plan should include continued education. What investment books will you read this year? What courses will you take to develop new skills? What events will you participate in to expand your network? Education is an investment that potentializes all other investments. Having a clear plan for 2026 doesn't guarantee everything will turn out exactly as planned, but it guarantees you'll be much closer to your financial objectives than if you simply wait for things to improve on their own. As Kiyosaki says, a bad plan executed is better than a perfect plan that never leaves paper. If this message spoke to you, Like this video so it reaches more people who also need to hear this. Share with someone you know who deserves to transform their financial life, and subscribe to the channel to continue receiving content that can open your mind and show new paths. Change doesn't start tomorrow, it starts now, with the decision you make today.